everyone. Thank you so much for joining. Today we look at impairment testing for property, plant and equipment. I will be doing another video to show you which types of assets are impaired, which are not, which are amortized, which are not, to provide you a better overview. But let's focus briefly on the example of PP&E. We talked about depreciation and amortization before. I made another video to explain you different depreciation methods and the impact on operating profit. When we talk about depreciation and amortization, those procedures serve to allocate the depreciable cost over a fixed long-term asset over the useful life. As I said, those assets decrease or lose value, and that's why we use depreciation or amortization to reflect the loss of value over the useful life. When we talk about impairment, impairment charges reflect unanticipated decline in value of an asset. Yeah, so this is not planned, this is an unanticipated decline in value. Both IFRS and US GAAP require companies to write down so-called carrying amount of impaired assets. I will explain what this means. Impairment reversals, once you have impaired your assets, reversals for identifiable long-lived assets are permitted under IFRS, but typically not under US GAAP. In general, and I'll explain you the formulas shortly, an asset is considered to be impaired when its carrying amount, that's the amount that you see in the balance sheet. It's basically the price you paid for the asset minus your depreciation, and then depending on how many years you have held the asset. This is your carrying amount. Think about carrying, the balance sheet carries the amount, exceeds its recoverable amount. Recoverable amount, think about, okay, if I need to get rid of this asset, either what money do I get, or if I think about this asset produces value, cash flow, what is the cash flow that it generates, which is also included in the word recoverable amount. So recoverable amount, really, what do I get from this asset? And carrying amount is how is it recording in the balance sheet. And you can think about, if the carrying amount is higher than the actual real value, the recoverable amount, then the value in your balance sheet is too high and does not reflect the real value of the asset anymore. So you need to write it down. Yeah? If it's the other way around, nothing needs to happen. Accounting standards, both IFRS and US GAAP, do not require that PP&E is to be tested annually for impairment. Usually at the end of a reporting period, a company assesses whether there are indications of asset impairment, and if there's no indication, then it doesn't need to be impaired. But if there's an indication that the asset has lost value because evidence of obsolescence, decline in demand, technological advancement, and so on, then the asset is tested. Usually the write-down happens via the income statement. You would have a new amount on the balance sheet, and the impairment loss is a non-cash item and will therefore not affect cash from operations. Yeah? Let's get started. Two things. First, IFRS. What you do to check whether you need to impair the asset is you compare the carrying amount with the recoverable amount. Recoverable amount under IFRS means the higher of fair value minus cost to sell. This is the scenario if you try to sell the asset. What do you get? Fair value. What is the selling price? Minus, are there any costs to clean the asset, to package the asset, and so on. So what is the amount compared to value in use, present value of future cash flow? Because the machine still generates hopefully some value. So what you do, you compare both of them, fair value minus cost to sell, with the value in use, the present value of future cash flow, and whatever is higher is your recoverable amount. Because think about, if your fair value minus cost to sell is quite low compared to value in use, the present value of your future cash flows, because your property, your plant, or your equipment still generates value, then why should you sell it for less if it still produces value? The other way around, if the machine or the property, the plant is quite old and doesn't generates much future cash flow, but your fair value is still quite high, you could sell the machine still at a good price, then your recoverable amount should be higher. So under IFRS, your recoverable amount is the real value of the machine, either by selling or based on the present value of future cash flow, and you compare this with your carrying amount. If your carrying amount is higher, the amount in your balance sheet is higher than the real value of the asset, then it is impaired. And then what you do, you write down to your recoverable amount. Yeah, I will explain you in detail based on an example. US GAAP is different. You do the same. You use your carrying amount. That's the amount that sits in your balance sheet. And you compare this with your undiscounted future cash flow. So here, when you do the comparison and the initial check, you don't care how much you can sell the asset for. You don't care about the present value of future cash flow. You use the undiscounted future cash flow to think about what is the value this asset generates. And again, if the carrying amount is higher, again makes sense because the value in your balance sheet is too high compared to the value the asset generates, then you test for impairment, or basically then you have an impairment. However, you impair the asset not to this figure as you do with IFRS. You check carrying amount with recoverable amount and you impair to recoverable amount. In US GAAP, you don't do this. You do the initial check, carrying amount compared with undiscounted cash flow. If impairment takes place, then you write down to your fair value, excluding cost to sell. So you write down to fair value. Yeah, it's a bit tricky, but let's look at an example. IFRS carrying amount 16K. Let's check whether there is an impairment. 16K, 16,000 is the amount that you see in your balance sheet. You compare this with your recoverable amount, which is the higher of fair value if sold minus cost to sell. So we have 9,000, 10 minus 1. You compare this with your present value of expected future cash flow, 12. This is your value in use, and you use whatever is higher. So here, your present value of expected future cash flow is higher, so you use 12K, and you compare your carrying amount with this one, which is in your case your recoverable amount, because 12K is higher than 9K. So you need to write. So first step is, yes, impairment needs to happen because carrying amount is too high. Second step, you write down to your recoverable amount. So you write down to 12. So you have an impairment loss of 4K. If your fair value, if sold, would be, let's say, 15K, 15 minus 1, then this would be 14. then your recoverable amount would not be present value of expected future cash flows. Then your recoverable amount would be fair value minus cost to sell, would be 14. And then you would have a write down from 16 to 14, and you would have an impairment loss of 2,000. Yeah, so recoverable amount under IFRS is always the higher between fair value if sold minus cost to sell. Under US GAAP, you look again at your carrying amount, which is 16K, but you compare this one first with your undiscounted future cash flows. So you compare this with 14, and then you see, okay, your carrying amount is higher, means we need to do an impairment, or the asset is to be impaired. However, you don't write down to this amount, you write down to a completely different amount, which is your fair value if sold. You write down to this amount. And to this amount only, you don't include cost to sell. So the impairment loss under US GAAP would be 6K, and under IFRS, what did we have? 16, 12, 4K. Yeah, bit tricky, especially under US GAAP, but once you do a few examples and once you understand, it's quite easy. So think about carrying amount is what you see in the balance sheet, and then recoverable amount, depending on whether you look from an IFRS perspective or US GAAP, can mean something else. But yeah, that's what I want to do. I feel looking at an example makes most sense. I will do another video to explain exactly what type of assets, intangible, tangibles, long-lived, indefinite, which one need to be tested for impairment and which ones are appreciated or depreciated in this sense, to provide you more details. I hope you found this useful. Thanks so much for listening. Bye-bye.